Hello, everyone, and welcome back to the live virtual classes from the Board of Studies. I am Kriti Chawla, and we have been progressing with the concept on transfer pricing. So we've already had two lectures where we discussed, transfer pricing. In the first lecture, if you guys remember, we started with transfer pricing as the basic concept. So what was the need to have transfer pricing? What does the law look like in India? So we discussed the definition of associated enterprises and international transactions in a lot of detail. After that, in the next lecture, um, we discussed transfer pricing methods. So in all, we discussed how do you really, compute the arm's length price, or how do you really determine the arm's length price. So I mentioned this was the slide deck that we were discussing. For today's lecture, I will just take you through those particular methods that we discussed. So these were the four methods that we discussed in the last lecture. Today we'll discuss the two other methods that are there. Then we'll discuss, some questions, some practice questions that I have for you, which are on the concept of transfer pricing methods. We'll also discuss how do you select a particular method. So what is the criteria for selection of the most appropriate method? And finally, we'll discuss something called as benchmarking analysis for today. So our agenda for today is going to be finishing this particular, slide deck. It's going to be very practical also today. I will be covering the transfer pricing manual that you have from the institute. But my idea will also be to give you just a bit of practical, exposure on how transfer pricing is actually conducted. So, my agenda for today, my objective for today will be to actually put everything into perspective. So, you've discussed arm's length price, you've discussed associated enterprises, international transactions, and all these methods. How does everything come together to undertake a transfer pricing analysis for a particular client? That will be my agenda for today. And obviously, I will keep examination perspective in mind for sure. So yeah, that's going to be the plan, for today. This is what we were discussing in the last lecture. So we were discussing what exactly is the arm's length price. I'm sure you know by now that, whatever is the price that is applied in an independent party situation, as long as it's comparable, that's called as the arm's length price. How do you determine arm's length price? Well, there are methods that we will be discussing today. There are several transfer pricing methods that actually exist, but then you have to look at what is the method that is best suited to your facts and circumstances, or your client's, facts and circumstances. There is no single method that is useful or considered suitable in all situations. You will just have to look at the best estimate out there. These were the methods that we were discussing. So there are traditional transaction methods, and then there are transactional profit methods. So these five methods, if you see, CUP, which is the comparable uncontrolled price method, resale price method, cost plus method, transactional net margin method, and profit split method. These five methods are provided in the OECD transfer pricing manual. In India, we have one more method, which is called as the other method. It's provided in Rule 10 AP. So in India, we have 6 methods for transfer pricing to calculate the arm's length price, whereas in the OECD, we have 5 methods to calculate the arm's length price. This is what we were also discussing in the last lecture, that there is no hierarchy of methods as such, and you have to, choose a method which gives or which provides the most reliable measure of the arm's length price. This concept is called as most appropriate method. So today, after we've discussed all the methods, I'll tell you how do you calculate, or how do you come up to something called as the most appropriate method. Before I get started for today, any questions from the last lecture? Any confusion? Any confusion that you might have? Okay. So, this was the first method that we discussed in the last lecture. We were discussing there's something called as CUP method. Can you put down a hint on what was CUP? Can someone do that? What is CUP? I think CUP is one method. You can just put down a few keywords to explain this method. Can someone do that? Okay, yes, compare the sale price to unrelated party. That's absolutely correct. So what you do in comparable uncontrolled price method is that you look for an uncontrolled transaction. As the concept, as the name of the method also suggests, you have to look at the uncontrolled price. What is the uncontrolled price? Well, the price that is adopted in uncontrolled transactions. Just make sure that it is comparable to your transaction. If that's the situation, well, then what is the price that is charged in that particular transaction? Just copy paste that particular price. That is the CUP method. It's the most direct method. And then there were these adjustments that we were discussing. So CUP method basically said that either there should be no adjustments between the independent party situation. So as an example, between this party and between this party or situation, in these two situations there should ideally be no difference out there. However, if there is a difference in these two situations, then can you adjust these two differences using some adjustments out there? Well, if you say yes, then you can adopt this price as the arm's length price in this kind of situation. Now these were the factors that were to be considered. This is not the only factors. Obviously the factors can go much beyond these as well. So but these are the factors that can be considered while selecting the independent party for the purposes of COP. After that, we discussed this particular example on the CUP method. And then we discussed that there are two types of CUP. One is something called as external CUP. External CUP was something that we have been discussing all this, while. If you want to, if you find out two independent parties in the market and they are also dealing in the same product, etc., then you can adopt their price as the external CUP price for the related party transaction. However, internal CUP was something which was internal to the organization. When I say internal to the organization, it basically means that a party out here is selling a commodity to a related party, and they're also selling the commodity to an unrelated party. So you can adopt the unrelated party price out here to benchmark this kind of transaction, the related party transaction. That is called as internal CUP. After that, we discussed the concept of resale price method. Can you tell me the situation where resale price method is applicable? In what kind of situations? Can you tell me in what kind of situation is resale price method applicable? Okay, yes, that's absolutely correct. In trading situations or distribution functions, is resale price method applicable. When I say, when I say resale price method, it basically talks about reselling a particular commodity. So if there is a parent company and that is actually selling the commodity to a subsidiary company, the subsidiary company is selling the commodity to, the end customer. So what the subsidiary company is actually doing is reselling the commodity, and hence this is called as resale price method. Now in this particular situation, what is the controlled transaction? Well, the controlled transaction is the transaction between the parent company and the subsidiary company. You have to justify that that particular controlled transaction is at arm's length. How will you do that? Well, what you actually do is to justify that 75 rupees out here is at arm's length. You can either justify 75 rupees. Alternatively, what you can do is calculate the profit margin at the subsidiary company level. The profit margin in this situation is 25%, and you have to justify that 25%, which is the price paid by the subsidiary company, is at arm's length. And this will be true if the profit margin which is earned by the subsidiary company either it is equal to or it is greater than the margins which are earned by similar Indian distributors. This is what the resale price method is actually talks about. Now, two things that you have to remember here is that there should not be much value addition at the subsidiary company level. If there is value addition, then it's not resale. We're talking about the concept resale. Resale meaning you get something from your parent company and then you sell it going forward. So maximum, you can do a little bit of value addition when it comes to marketing or when it comes to packaging of the product, etc. But just make sure that it's not major, value addition, because if it was a major value addition, then it's not really, like a distributor trader that we're, talking about, and resale price method would not be applicable. Another thing that you have to remember is that there are no intangible assets which are used to add value right here at the subsidiary company level. Because if there are intangible assets, then it's not really like a resale. Then it's, another kind of sale altogether. Because that intangible asset might just change the characteristics of, the commodity which is sold by the subsidiary company. So this is a simple resale transaction, which is applicable in the case of traders and distributors. We discussed this example of resale price method, and then we discussed the cost plus method. Can you tell me what is the cost plus method applicable for? What kind of situations? Where is the cost plus method applicable? Okay, which situations? Yes, that's absolutely correct. It's applicable on contract manufacturing situations or manufacturing, agreements. So in this particular situation, what you do is you see a subsidiary company which is manufacturing a commodity. What you do is you look at the markup which the subsidiary company is earning in terms of transferring the product or in terms of selling the product to the parent company. Let's say in this particular situation, the subsidiary company is selling the commodity to the parent company at 125 rupees. Now, to justify that 125 rupees is at arm's length, you can find out other independent parties in the market who are also selling the commodity at 125 rupees. However, at the same time, you can, instead of comparing the price, which is 125 rupees, you can also compare the markup out there. So what is the markup in this particular situation? Well, the markup is 25 rupees or 25%, so to say. So you can compare the markup, which is earned right here in this kind of situation, with the markup, which is earned by comparable independent parties. As long as it's same, or the markup that the related parties are earning is actually greater than the markup which other parties are earning, then this is at arm's length. This was just an example right here in which, let's say that there is an associated manufacturer and the manufacturer is selling a commodity to a distributor. This is for 1 lakh iPhone cases. And we need to know that, what is the cost? We know the cost plus what is the markup that should be added in terms of selling the commodity between associated manufacturer and distributor. What do? We look for independent third-party manufacturer and third-party distributors. We find out that they are actually transacting at a markup of 5%. So what you can do is you can adopt this 5% of markup to this related party situation, so as to say that this is at arm's length. This was, the example that we were discussing, so as to see. Sorry, this was the example that we were discussing, which was for the cost plus method. And after that, we started with the TNMM method. In terms of the TNMM method, which is transactional net margin method, we were comparing the net margin, the net profit, which is dividing by it, the relative, an appropriate base. Now, this whole concept of net profit, the ratio of net profit dividing it by an appropriate base, this ratio, this is called as profit level indicator. So what you do is in the TNMM method is that you compare the PLI in a controlled transaction with the TNM, with the PLI that is earned in an uncontrolled transaction. So compare the PLI in both the situations, and then accordingly you have to judge whether the controlled transaction is at arm's length or not. Can you tell me what was the concept of tested party in TNMM method? Quickly, if you can just, very, very briefly write it down. What was the tested party? Okay. This is, the tested party. When it comes to the TNMM method, okay, great. We do have answers. Yes, against which the control transaction is basically tested. It basically means to say that the verification of the controlled transaction is basically done from the perspective of tested party, meaning to say that if we have a situation where this Indian company is providing services to the foreign entity, which entity should we take against which we will test the profitability, so as to make sure that this is at arm's length. We can do it from the perspective of the Indian company, or we can do it from the perspective of the foreign company. So whichever company that we do it from the perspective of, that is basically called as the tested party. Now, we were discussing that there is no definition of tested party as such. It's just the least complex entity which is considered as the tested party. There is no definition in India for tested party. There is no definition in the OECD for the concept of tested party, but they just say that it's going to be the least complex entity which is considered as the tested party. These were some of the examples that we were discussing, and this is one example that we discussed for the TNMM method. In this particular situation, the first step was to determine whether they are associated or not, the entities, and then determine the operating profit margin in both the situations, and then compare it in that situation. You can get questions, where step one will be to consider whether the two entities are associated or not. So it's more like a mix of section 92A application, where you determine whether the entities are associated or not, and then section 92C, which talks about these particular methods. Any questions? If there are no questions, we'll start with the concept for today, which is going to be the profit split method, followed by the other method. Any questions? Okay, so this is going to be the next method, which is the fifth method from the perspective of the OECD and the Indian transfer pricing regulations. And this particular method is the profit split method. Now, this is a method which is used in case of unique intangibles. Whenever you see a transaction which involves unique intangibles, that is where the profit split method comes into existence. Another area where profit split method comes into existence is where the transactions are very, very interrelated, that they cannot be evaluated on an individual basis out there. When I say that transactions are very, very interrelated, is that you look at a particular transaction from the perspective of a product itself. When I talked about TNMM method, I said that there is the provision of IT services. So in between doing like a lot of transactions, I could have kind of a transaction. However, in profit split method, the transactions are so interrelated that you cannot really segregate the transaction on an individual basis. And that is where this particular method comes into place. So in this particular method, what you do is through the entire transaction, which obviously is, put together, through the entire transaction, you undertake, like a functional analysis. You try to ascertain that what is the profit split percentage, and how independent parties, if they were undertaking this kind of transaction, how would they have, split the transaction in that sense. And that is basically called as the profit split method. This method is a little technical. It's only used in case of, as I mentioned, unique, intangible kind of, situations. So what we'll do is we'll look at two examples right here to discuss what exactly is the profit split method. Let's take the first example, which is provided in blue font, and this is the second example, which is provided in blue font. Sorry, black and blue font. So when we look at the first example, it talks about two associated enterprises. Now, these two associated enterprises, they together invested a total of $500 billion, and they wanted to come up with a new medication into the market. Obviously, when you talk about a new medication that is coming into the market, there is a lot of research and development that goes into getting up. Coming up with a new medication, or coming up with a new formula. And then there are other aspects also. These other aspects could be manufacturing, it could be marketing, it could be distribution, etc. So these two AEs, they invested a total of $500 million to come up with a new medication. One company provided R&D, which was $375 million of the total investment, and the rest was actually done by the other enterprise. So we find out that if you look at 375 from the perspective of 500, it's actually 75% out there. So what we decide is, today they have contributed this much. Going forward, they will be getting a lot of profits. Now the profits will be divided in the ratio of 75:25. So the R&D company will get 75% of future profits, and the drug manufacturer, or the other companies that have done other tasks, they will get the remaining 25%. So what we do is, in this kind of situation, the transactions were quite interrelated out there. There was an intangible, there was a unique intangible that was into place. There was R&D, and the R&D contributed to the development of a new intangible. This is the reason this kind of transaction would involve a profit split kind of method. And what we've done is we've split the profit, the future profits, in the ratio of investments that was actually undertaken in this situation. This method is a little more technical. It's not this easy, but then this is the essence of the profit split method. As the next example, let's say that there is a manufacturer, and the manufacturer owns a brand. Now, it sells the products to an affiliate in the other country. The affiliate in the other country then sells it to third-party customers in that particular country. Now, what is the manufacturer doing? The manufacturer is obviously manufacturing that particular commodity. They own the brand also. What has the affiliate done in the other country? Well, the affiliate has built up, they have invested some money in building up a customer base in the other country. They have developed the market in the other country so as to sell the products of the manufacturer. So then the point is, what happens to the profit that these guys will make? Well, the profit, ideally, all the profit should not go to the manufacturer only. Why? Well, that is because a lot has been done by the affiliate company. They have built the customer base, they have developed the market in the other country. So whatever is the profit that is actually generated, it should actually be going to the manufacturer. It should be going to the manufacturer for building the brand. It should also be going to the affiliate company in the other country. Now the point is, how do you really split this particular profit? Well, what you can do is you can split it on the basis of functional analysis. You can split it on the basis of functions that are performed by the manufacturer and the functions that are performed by the affiliate country. Or what you can do is, if you find a similar situation in independent parties, if you find out independent parties in the market who are undertaking similar functions, you can replicate their behavior also. So this is how you split the profit, going forward. Uh, Yeah, so that is basically, the profit split method. This is just a slide that talks about the recap of the profit split method. You can actually find this in, the manual also. So that is the profit split method. What you have to remember is that the profit split method is applicable for unique intangibles, and it is applicable for a situation where the transactions are very, very interrelated with each other. I have question on the chat box which says, where can we access the slides? Um, you can access this. I will be uploading the slides. I will be sharing the slides, with the BOS team, and you can access it from them, or you can get it from the portal itself. But just allow me some time. I haven't uploaded the slides as yet. I will be doing that shortly. Okay. The next method, or the last method, is basically called as the other method. But before that, any questions with respect to the profit split method? Any questions? Okay, no questions. Now, the next method is basically called as the other method. When it comes to mentioning this again, because this is an important thing to remember, is that this is a method which is very, very specific to Indian transfer pricing regulations. This is also referred to as the sixth method in transfer pricing. It's also called as the other method. It's also called sixth method in transfer pricing. So what is the other method? Well, this is what Rule 10AB says with respect to other method. It says it is any method which takes into account the price which has been charged or paid, or price which would have been charged or paid for same or similar uncontrolled transaction with or between non-associated enterprises under similar circumstances. So what this method is really trying to say is that, can you find out independent parties in comparable situations? I say yes. Um, if I say that what is the price that they have charged, well, this is more looking like CUP. But where this method actually differs is that it says that what is the price that they would have charged if they would have entered into that kind of transaction. So let's say that I have entered into a transaction, today, with respect to a particular, service. Now, I need to find out, I need to justify that this is at arm's length. How will I do that? Well, I can look at independent parties and I can take a quotation from them. The quotation will say that if they had transacted at, going forward in that particular transaction, they would have been charged or they would have paid this kind of, money. So this is where, the other method actually comes into place. So for the purposes of other method, what we use are third party quotations. We use tenders or bid documents. We use valuation reports. We use, negotiation documents, etc. And we try to justify to the tax authorities that if the transaction was undertaken between independent parties and it would have been in comparable situations, this is the price that would have been, charged between them. So this is basically called as the other method. Where does other method really come into place? It practically we use it for reimbursement transactions between associated enterprises. But otherwise, if you want to justify using other method, you need to have third party quotations to actually do that. Um, this is the slide that actually talks about, the application of methods. So I've created a small table which will help ascertain which method is to be used when, in what situation. The first one actually talks about CUP method. I have given, a reason. I have given, examples of transactions where CUP methods can be useful. So it could be a loan transaction, it could be a service fee transaction, it could be transfer of, goods, it could be transfer of intangible, sale purchase of goods, etc. So these kind of transaction is where CUP, or the comparable uncontrolled price method, is actually useful. Can you tell me what is the essence? Where exactly, on a more generic basis, can CUP be used? These are very specific transactions, but very generically, on a more general basis, where can CUP be used? Can you give me an example? Okay, so CUP method, or the comparable uncontrolled price method, can be used in a situation where data is actually available. Wherever you see that data relating to independent party situation is available, and that independent party situation is comparable to your situation, well, that is where CUP method is applicable. Now, this transaction could be anything. It could be a loan transaction, it could be a service transaction, it could be, an intangible or a tangible transaction. It could be any kind of transaction. It could also be, more like a service transaction. It could be provision of services as well. But as long as there is data which is available on independent party situation under comparable circumstances, CUP method is something which will be useful. RPM, and even in questions, from an examination point of view, even in questions, if you see that there is data relating to related party, and then they have also given you information with respect to how that transaction is undertaken between unrelated parties, well, that is where you can see that CUP method could be, useful. RPM is used where not much value addition is there, and wherever you see that there is a trading situation or a distribution situation, that is where you can use the RPM method. CPM, cost plus method, is used for manufacturers, contract manufacturing situations as well. So wherever you see, manufacturing being undertaken, generally you can use cost plus method there. TNMM method again is for, situations where you have a transaction and where you have information with respect to net operating margin available with respect to that particular transaction. So wherever you have net profit, data available, wherever you have operating margins available, it could be anything. It could be provision of services, sale of goods, etc. But if you have that kind of information available, that is where TNMM could be, useful, because TNMM, it actually compares the net margin. So if you have information in calculating the net margin for the related party and for the unrelated party, that is where TNMM is a method that can be useful. And finally, PSM, profit split method, is used in a situation wherever you see unique intangibles, like the R&D that we just discussed, the research and development that went in producing a new medication for the market. That is where you can use the profit split method. If you read through the following factors, so if you see, you have to look at the nature and class of the international transaction. You will have to look at what is the international transaction all about? What is the nature of the transaction? Is it a trading situation? But in looking at the functions that are being performed, is it a manufacturing function, a distribution function, which is, being performed? Then you have to look at the availability and reliability of data. If you have all the data which is available, obviously you can comparability, you have to take into consideration. Obviously, you can rely on this table also for the purposes of identifying which method will be useful when. Any questions with respect to the method? With this, we finish with all the methods out there for the purposes of calculating the arm's length price. And now I have two practice questions for you. This is the first one. And the second one, to just help you ascertain which method is applicable when and how do you calculate ALP when it does not give you perspective on which method is to be used. But before that, any questions, or shall we just go ahead with the practice questions? Any questions? Shall I go on? Shall I go forward? Can you give me a perspective of the questions? Okay, okay. Thank you so much. Yes. So this is the first practice question. I advise you to take 2 minutes and just go through the question. Just take 2 minutes, read through this particular question, and then we'll discuss it. Okay, looking at the preliminary understanding of this particular question, can you guess right now what is the method that will be useful in this situation? What is the method that you can use to compute the arm's length price? Yes, that's absolutely correct. There is an answer on the group which basically says, yes, CUP method is what you can use in this particular situation. So this question starts with I Limited, which is an Indian company, and it's supplying billets to its holding company, which is U Limited, during the previous year. It also supplies the same product to another UK-based company, which is V Limited, an unrelated entity. Now, the thing is, when you get this kind of question, it's always essential to start with the question by assuming that if this is an Indian company and it's actually supplying billets to its holding company, these two are associated entities by virtue of Section 92A. I will display the answer, but this is what is expected out of you to say that these two are associated entities with respect to Section 92A. So this is what you have to mention. This is what you have to mention for the purposes of answering this particular question. Now, the next thing that you have to mention is that that COP is something that you will be applying in this particular situation. Obviously, there is one thing to say that you're making all the calculations and you're doing all the calculations and coming up with the answer, but you also have to answer a particular question in a format out there, and that is what I'm trying to tell you here. The first thing that you have to mention here is that these are associated enterprises by virtue of Section 92A. The second thing that you have to mention is that you feel that there is CUP method that will be applicable in this particular situation. And this is where you have to justify why you feel that this is CUP which will be applicable. Well, you tell them that, there is data which is available and this Indian company is supplying billets to its associated entities, and they're also supplying billets to its non-associated associated entity or an independent entity. Now, looking at what kind of comparable is this? What COP is this? Internal COP or is this external COP that we will be using here? Any perspective? Is this internal COP or this is external COP? Yes, absolutely correct. This is internal COP that you'd be using out here. So you'll use internal COP and tell them that, because data is available, you shall be relying on this particular method for the purposes of computing the arm's length price. Now, yes, I do understand that, you have transactions with U Limited are priced at FOB, and transactions with, V Limited, which is an unrelated party, are priced on CIF basis. So in the answer, the next thing that you'll mention is that we shall make an adjustment, for this particular, a reasonable adjustment so as to compare the two prices out there. And this is the adjustment that you will make. You always, as I mentioned, start with the uncontrolled transaction. If you remember, when we discussed the other example also for COP method, I told you that you start with the uncontrolled transaction, which in this particular situation is 700 rupees. Now, when you look at the uncontrolled transaction, this is on CIF basis. So what you do is you deduct the cost of insurance and freight to actually make it on FOB basis. So you deduct 200. 200 is something which is mentioned here, that insurance and freight amounts to 200, units out here. So the adjusted price that you actually find out is that it should be 500. Now the adjusted price, which is for V Limited, which is for unrelated party, is actually the same as the transaction between related parties. So now, because the unrelated party and the related party are transacting at the same price, that basically means the transaction has been undertaken at arm's length price, and there is no adjustment that will actually be required. So what I'm really trying to say is that not always that you'll find questions with, adjustments. Sometimes there are no adjustments because the transaction is rightly priced at arm's length for the purposes of related party situations also. So this is how you tackle, the answer. When I upload the slides, just make sure that you go through this particular text right here so as to see how do you really answer a particular question. There is one thing to arrive at the answer, and then there is another thing to actually give a structured answer out there. And this is what this slide will help you with. This is the second practice question. Again, I just request you to take 2 minutes and go through this particular question. Well, it looks like, okay, now that you have read through the entire question, it looks like it's a lot of calculations, but it's a little maybe less. Let's see. So in this particular situation, they're talking about M Limited. It has its registered office in Mumbai and it's engaged in multiple businesses. So what they're really trying to say is that it is an Indian company. It has borrowed 200 crores from SBI, for which 100% guarantee was given by the parent company ABC Incorporation of country A. The total borrowings are 1,000 crores. Now they've given you this particular information, and you have read through the entire question. Assess when the two entities are associated. Talking about M Limited and ABC Incorporation. Yes, the two entities are associated. What is the clause by which they are associated? Well, this is again Section 92A, and you can actually quote, the guarantee clause out here, which basically says that the two will actually be associated. So this is going to be, 10. Yes, so this is going to be clause D, which basically talks about, guarantee transaction, 10% or more question. So how do you start with the CUP method? Well, we start with the uncontrolled transaction, the independent party situation. So in this particular situation, they say that ABC Incorporation would have billed 24 crores for supply of identical quantity of similar mobile phones to other customers. So they would have used 24 crores right here. So this is the 2400 crores that you actually start with. And because in an unrelated party situation and a related party situation, there are the first adjustment that I can see right here is for royalty. Now, the royalty which is payable by M Limited, this is what the royalty actually looks like. So going back, this is the royalty situation. The mobile phones are branded, for which royalty of 100 INR per mobile phone sold is paid to ABC Incorporation. Similar mobile phones are sold, but no royalty is actually charged. So what I'm really trying to say is that there is no royalty in this particular situation, in an unrelated party situation. But in a related party situation, there is royalty. So what you'll do is you'll add the royalty in this situation also. 100 per mobile phone into the that will actually give you 10 crores, which is just allow me some time. To other customers, no royalty is charged for them from them. So in this particular situation, which is the 2400 crores, there is no royalty here. And what you have to do is to make this particular situation very close to your related party situation. And in related parties, there is royalty which is actually charged. So how do you make them closer to, how do you make them similar to the related party situation? Well, you add back the royalty. Similarly, what you do is, in terms of the credit period which is available, the cost of capital for 100 crores, and it is for 1 month, so 1 by 12, this is 20 crore. This is also added back. So what you get is 2430. So when this kind of transaction was happening, between unrelated parties, it would have happened at 2430 crores. How 2430 crores? 2400 is the price, and if it was very, very closer, if it was in the similar situation that related party transaction has happened, these were, the functional adjustments. This is how we have tried to bring it closer to a related party situation. So this is going to be 2430 in a uncontrolled situation. What is the purchase price between related parties? Well, this is 2600. Where is 2600 coming from? Well, this is where it's provided. 10 lakh mobile phones were bought for an aggregate of 2600 crores from ABC Incorporation. So in related parties, what was the price? It would have been 2600. So what is, the difference out there? Well, it is 170, and this is the amount that will be added to the total income as a transfer pricing adjustment. So you have to compare the related party price with unrelated party price. Now I found out that the unrelated party price was a little different from a related party price. So what you do is for CUP, as I keep mentioning, you start with the unrelated party price and then you bring it closer to related party price using all the, functional differences, using all the adjustments that are actually provided here. So what we did was in this particular situation also, um, in this particular situation also, what we have done is we arrived at 2430, which should have been charged. However, what was actually charged? It was 2600. Why did they do that? Well, to maybe, get into tax avoidance, so as to make sure that the amount of profits that they're actually receiving or getting is lesser. So what you do is you add back 170 in this particular situation also. So that is basically how questions are actually done with respect to CUP. Uh, this is how it's actually mentioned, that it is 10%, out there. So because this is closely related to the credit period, obviously it is calculated on the basis of 2400. Because this is it was 2400 because that is the that is the unrelated party situation, and you're trying to bring the unrelated party closer to the related party. So you cannot take the related party prices. You always start with unrelated party because that is something which is uh, where you can actually make adjustments. You cannot make adjustments to your related party situation in this scenario. Okay, any other question? Okay, if there are no further questions, this is what we actually start with, which is benchmarking analysis. And this is, the concept benchmarking that you might have heard a few number of times when it comes to transfer pricing. This is the new concept that we start with for today, which is basically the process of identification and selection of comparable companies. Now, all this while I have been telling you that how do you use a particular method, like for CUP, when we were on to the method which is the cost plus method, which was this one. I said that you have to look for comparable companies in the industry. When I say comparable companies in the market, the comparable companies are sometimes referred to as comparables. So you have to look for comparables in this situation. When we moved to the next method, which was, the this resale price method, I said that you have to look at, comparable companies out here so as to justify the profit margin at the subsidiary company level. I said that you have to look for comparables here. When we moved to the cost plus method, there was a comparable that we used here also. When we moved to TNMM method, I again mentioned the same thing. I said that, you have to look for comparable companies. You have to look at independent parties which are undertaking the transaction in comparable situation. So you have to look for comparable companies out there also. And you have to compare the profit margin there. So what you have to look for are comparables out there. Um, So how do you really find out? So how do you really find out comparables? How do you really select comparables out here? That is the whole process of benchmarking analysis. So what we'll do now is look at this particular concept on how do you really find out comparable companies. What I'll do is I will look at I'll help you just go through the softwares also, and then we will look at this particular concept, and then we'll look at a little bit of technicality, which is using the arithmetic mean and interquartile range and all these things. So let's take a 10-minute break here, come back after 10 minutes, and we'll start with the process of benchmarking analysis. If you have any questions, meanwhile, just feel free to post them on the chat box. Okay, thank you. So yes, we were talking about benchmarking analysis, and that is the entire concept of identification and selection of comparables. All through the lectures, I've been telling you that it is about selecting the comparable companies, and that is what we do in benchmarking analysis. So before we actually start with that, before I actually tell you about the entire concept of benchmarking analysis, this is the slide which basically talks about the process of finding comparables, just to make sure that a particular transaction is in sync with arm's length principle as per the Indian TP regulations. It involves search for suitable comparables in order to determine the ALP and to actually substantiate that the tested party has undertaken the transaction at ALP. So that is basically the concept of benchmarking analysis. Now, the thing is that if you look at transfer pricing regulations, in India, they do not really prescribe a particular process out there for selection of comparables. It's not like the transfer pricing regulations say that, this is, what you have to do. These are the steps out here. I've written the steps here, and this is not what, the transfer pricing legislation in India actually says. There are a lot of decisions. There are a lot of decisions of the judicial authorities, and they have provided guidance on how data is actually available in the public domain. How do you use that particular data for the purposes of conducting benchmarking analysis? So this is the reason. It's not as if it's provided in the law. It's actually something which is very practically oriented. This is what we learn practically on how to find out comparable companies. So how do we do that? Well, the first step is to actually look at a particular database. Now there are a lot of transfer pricing databases out there. These are all private databases, and they have information on a lot of companies. So we select a particular database. I will be talking about these particular steps in very, very briefly, because I have slides for all these particular steps. So we will go through these particular slides going forward, but very, very briefly I will just tell you what the step really looks like. So first, what you do is you select a lot of a database. Now, because there are a lot of databases available in the market, and these are all competitive companies, you have to make a selection what database is suited to your circumstance. Now, when you enter the database, when you look at a particular database, you have to select the industry. Now, let's say, remember, we were discussing comparability factors, and I was telling you how the industry is also important. So you cannot compare a transaction which is in a pharmaceutical industry with a transaction which is in the manufacturing of automobile industry. So this is the reason you have to select the industry where your client actually belongs to. Then there are some quantitative filters, there are some qualitative filters that you have to apply. This is basically the work that we do in Excel. We use Excel, we use spreadsheets actually to do a lot of work. So this entire benchmarking analysis involves a lot of work, in spreadsheets that we actually undertake. Then we undertake a qualitative analysis, and finally we are able to come up to, a set of comparable companies. Now, the thing is, if you have a transaction, let's say that there is an Indian company that has actually provided services, IT services, to the USA company. This is the example that we discussed in the TNMM case also. So there is an Indian company, it has provided IT services to the USA company. Now we need to justify that this is at arm's length. How do we do that? Well, I said that you have to look at comparable companies in the industry. Now, when you look at a database, there could be one company that you find comparable, or there could be 10 companies, 12 companies, there could be 20 companies, there could be 26 companies, there could be 4 companies, any random number of companies that you actually feel are comparable to your situation. So that is the number of comparable companies that we list down out there. Now you might be wondering, how do you go ahead with comparing it with multiple number of companies? I'll tell you about that, but there could be any number of companies. So what you have to do through the entire process is something called as documentation. You have to document everything when it comes to transfer pricing. And this document is something which is useful in the scrutiny stage, or wherever. In litigation, basically. So documentation is something which is very, very important. How have you been able to find out those number of companies? That is what you need to document out there. So this is the entire process on benchmarking analysis. Let's start with the first step, which is basically called as selection of database. Now, the thing is, what is this, database? Well, this database is more like a domain, and this is where all the financial and non-financial information about the companies, are maintained. So when you open a particular database, because these are all competitive, very, very competitive, companies, and because there are a lot of databases available in the market, you will see a lot of companies, out there which have their information put up in these particular databases. All the databases, they have their own pros and cons. They have their own advantages. But then if you look at, these particular databases, all the databases will allow you to search the companies by their name, or by their business, by the industry that they operate in, by their codes, SIC codes, if geographical location, etc. And all these companies will have their financial information put up out there. Now, okay, let me, just tell you about a few databases out there. These are some of the examples of, databases which are used for transfer pricing purposes. Now, the first one is, something which is called as Proves. Proves is a database which has financial information of a lot of Indian companies. These can be, listed companies. These can be these could be private, companies. These could be companies, unlisted companies. All the information you will find on, Proves database. The thing is that these companies could belong to different industries also. So you will have information on, the pharmaceutical industry, the automobile industry, the healthcare industry in general, or, IT industry, ITES industry, KPOs, BPOs, etc. Anything basically. So you'll have a lot of companies out there. Then there is something called as Capital Line TP. Now, Capital Line TP is also a digital database which has, a database of more than 35,000 companies. It also includes, private, public companies, cooperative, joint sector companies, etc. All of them are, provided there. Now, the thing is that because these are all private companies, Proves, Capital Line, etc., they're very, very competitive. So if Capital Line has 35,000 companies, Proves would also have, similar number of companies, out there. You can obviously make a Google search, go to the website, and then, you'll get to know the number of, the number of companies information that they actually have, but it's almost like, similar to each other. Then there is another thing which is called as ACE, TP. This also has all the information on, the company's financial, non-financial, etc. Now, the thing is, how do you make a selection? Which, software that you are actually going up with? Well, not really. You can use any software because, as I mentioned, these are very, very competitive softwares, or these are very competitive databases out there. So you can use any software out there. Practically, there have been, circumstances where I have, or we, basically have used, two softwares out there. And going forward, I'll tell you why we actually do that. But we have, run search. We have done this exercise of finding comparable companies, searching comparable companies in one software, and we've done that in another software as well. So that even if there is one comparable company, it's not actually, left out. So we have done a holistic, search that way. But then it depends on a general basis. You can use any software. One software will actually be enough to actually search for, comparable companies. Now, apart from these particular softwares, there are also other softwares out there. These three are Indian softwares, but then there are international softwares also. So if you now choose to take the tested party as a USA company, you will have to compare it with USA entities. Remember my example, the Indian entity is providing IT services to the USA entity. You can take either as the tested party. If I take Indian entity as the tested party, I will calculate the net operating margin of the Indian entity and then compare it with the net operating margin of other Indian entities. Where will I find other Indian entities? I could find them on Proves, Capital Line, ASTP, etc. But what if I choose USA entity as the tested party? Well, then I will have to ask for the USA company's financials, calculate the net operating margin. What do I do next? Next, I will use a USA software where I can find information on USA entities and calculate their net operating margin and then compare it. So these are international softwares you can use to compute the profit margin and to search for other USA companies also. Now, these are international softwares. Then there are softwares which are very, very specific to transactions. Let's say that there is a royalty transaction. One entity has provided or paid royalty to another associated entity. Now, in these kind of situations, you have to justify the royalty percentage or a royalty amount. For these, there are softwares like royalty range, there are royalty stat, etc. And these particular softwares will have agreements, intercompany agreements that can actually help you in benchmarking or in finding out independent companies who have also undertaken royalty transactions. So those are another kind of softwares out there. There are many around the world, and you can just make a search on the kind of softwares that there are. But these three are very, very widely used Indian softwares. Okay, so there are questions out there which says at this stage, I wanted to know who applies these methods for transfer pricing. Is it the income tax department or is it the assessee themselves, also through professionals? Well, the onus, the burden of proof in transfer pricing is on the taxpayer. When I say that the burden of proof is on the taxpayer, it's actually the taxpayer who undertakes the transaction. That's step one. And then step two is for the taxpayer to identify whether transfer pricing provisions are applicable on the taxpayer or not. If the taxpayer finds out that yes, transfer pricing provisions are applicable on the taxpayer, they will have to choose the method that is applicable to their situation, and they will have to undertake the entire exercise of benchmarking it, of convincing the tax authorities through documentation that yes, their transaction is at arm's length. So the burden of proof to prove that the transaction undertaken is at arm's length is on the taxpayer itself. It's like self-assessment that we have. We calculate our tax, whether it is through professionals or whether it is the taxpayer on their own basis, but it's basically self-assessment. Similarly, in transfer pricing also, when the taxpayer undertakes the transaction, they have to justify and they have to choose which method is applicable onto them. And accordingly, they file something called as Form 3CEB, which is very, very casually called as transfer pricing return. They file that particular return where they will actually put in the information that, this is the transaction that has been undertaken. This is the amount that the transaction has been undertaken at, with which related party. And then they have to justify which method of transfer pricing they have used to justify this particular transaction and how they have justified the entire transaction, etc., which database they actually used, etc. This is the entire documentation that is actually prepared by the taxpayer from an Indian perspective. So yeah, it's basically the taxpayer who has to undertake all these things. The thing is, I do understand, but then the thing, okay, there's another question. Why would someone prove on its own unless insisted by the income tax department? Well, because you have undertaken a transaction, and if it is with a related party, you have to prove that this is at arm's length. It's more like a declaration. It's more like a declaration which is given by the chartered accountants that this transaction which has been undertaken by the taxpayer with the related party is at arm's length. So I'm not saying that, if you undertake transactions with unrelated party, why do you have to prove it and, etc. But then, yes, if you undertake a transaction with a related party, there is a requirement that you have to prove it to the tax authorities through, or you have to just give that information to the tax authorities that, yes, this is at arm's length. So this is the information, basic information that you have to do from an Indian transfer pricing perspective. I do understand that, it's becoming a little confusing because we've not discussed documentation right now, but in the next lecture, or let me see, I'll try for today. I don't want to rush through this particular, concept, because searching the comparables, this is an important concept. But if I'm able to, I'd actually discuss documentation today and just give you like a very, very small perspective, at least today, on what is the kind of documentation that we have to draft from a transfer pricing, perspective. And the thing is, it's only practicing chartered accountants who can actually file, transfer pricing returns. No, Form 3 CEB. Technically, it's called Form 3 CEB or Accountant's Report. Casually, it's referred to as transfer pricing returns. So it's actually practicing chartered accountants who have to provide, that certification, who actually provide that certification to the taxpayers. So I'll tell you about that. And why are we, getting into that particular database, etc.? Why are we selecting the database? Why are we doing all this exercise? I'll tell you, because that is everything goes into this particular documentation, and documentation is very, very important from a transfer pricing perspective, because if case goes under scrutiny, then this is what will actually save the taxpayer. So I'll tell you about that also. Just give me some time. Okay, so coming back, these are, the databases, the different databases that we have. These three, as I mentioned, are from an Indian perspective. Now, this is how the Provis database really looks like. This is, a slightly old, software screenshot, but I think I should update it. But yeah, I'll update it in a while. But yes, this is, on a more casual basis, how a particular software, looks like. Provis kind of software really looks like. So when you enter the software, the first thing it will actually ask you is, okay. The first thing that will actually ask you is all industries. Which industry are you looking at? This basically means that which industry does your client or does your, situation, belongs to? Does it belong to a pharmaceutical sector? Does it belong to automobile sector? Because you wouldn't want to compare a pharmaceutical sector to an automobile sector out there. So this is the reason we choose a filter out there. And the first filter that we choose is basically called as the industry filter. If you guys remember, we were doing comparability analysis. We were doing those 5 comparability factors. And I mentioned that, there are economic circumstances and business strategies, etc. So this is putting that comparability factor into practical applicability. This is where we choose, the first filter. So let's see that, we've chosen banking services. There will be an option out here which will say add to current OSC, the spreadsheet, or use a new spreadsheet. We choose that particular option and we select the companies. And these are the companies that it will actually give us. Let's say that they've given us 207 companies and we've added all these 207 companies into a particular spreadsheet. Now, these are the 207 companies which belong to our situation. Now, what we'll do is, we're using TNMM method and we know the net profit margin of our client or, of the taxpayer. Now, when we have the net margin of the taxpayer, how do we have that? Because we have the taxpayer's financials and we are capable of finding out the net profit margin using the taxpayer's financials. So we have that information ready. Now, what we need to do is to find out the independent company or the comparable company's net profit margin and then compare it. So then how do you compute the net margin of comparable companies? Well, we select financial statements and ratings out there. This is the query that we put. And in this particular query, we ask for audited financial statements. This basically means that for those 207 companies that we have selected, we now need financial statements. Why financial statements? To calculate the net profit margin. So this is, the breakup that it will actually give us. It will say that, yes, you do need audited financial statements, but within that, what do you need? What information do you need? So, I tell them that, listen, I need sales, I need expenses, and all other things that are needed to calculate the net operating margin. So I tick on, whatever things I need out here to calculate the net operating margin of those comparable companies. And this is the kind of sheet that it actually gives me. So for 3 years in this particular uh, uh, example, this is pretty old. It says 97 for the year 1997, 1998, and for 1999. They've given us the sales figure and they've given us the total expenses figure so as to calculate the net operating margin. Obviously, you can ask for more information, which will be needed to calculate the net operating margin. But right now, this is, what they have actually given us. And I will also tell you why for 3 years. So what they've actually done is for those 207 companies, they've given us all these, figures out there. There are some places where you will see that there is no information which is actually provided. So we'll actually cancel out and we'll cut out those particular companies. That is because, the software does not have information on those particular, companies, these particular things. So what we'll do is, because information is not available, we'd actually like to just, cut out those particular, companies from the framework. So what we'll do is, this is basically how a search process really looks like. So just explaining this is what we will, this particular sheet is what we will export to a spreadsheet. Let's say for an example, we will export this to Excel. Now, what do? We have 207 companies. We need to break them down further into lesser number of companies. How do we do that? We apply some filters out there. So the kind of filters that we apply in an Excel sheet are called as quantitative filters and qualitative filters. Why do we actually apply these particular filters? Because, we would want to actually find out comparable companies that are very, very closely associated. They're very, very close in terms of functionality to our taxpayer. So this is the reason we'd like to filter down, the companies out there. So the total number of companies that we found out from the software were 207. How do we filter them down? We take them into the Excel sheet. So now what we do is we apply something called as qualitative filters and quantitative filters. The first thing that we apply are quantitative filters, and quantitative filters are something that are applied in the Excel sheet itself. So the first quantitative filter that we'll apply is sales greater than 0. So that basically means that we'd like to only, and this is, you'll have to obviously make a formula in Excel so as to apply this kind of filter. But this kind of filter basically means that we would like to actually accept and have only companies that have sales more than 0, that have information on sales available. If you do not have sales information available, like, out here, and out here, there are blanks out here. You don't get so many blanks, but generally, if you have blanks out here, then we would not want to, use that particular company. So just, cancel out or just exclude companies for which sales information is not available. So the first filter that we apply is sales, greater than 0. The next filter that we apply is again, in terms of the size of the transaction or in terms of, sales again. So we'll actually try to tell them that, sales should be greater than, let's say 10 crores. Why sales greater than 10 crores? Well, that is because our company or taxpayer is basically a small taxpayer with a sales of around 10 crore rupees. So what we'll do is we would not want to, select companies that have a sales of, let's say, 1,000 crores, that are really big companies. So then we apply a filter accordingly. So this is the next filter that we apply, that because we want the companies to be very, very close to each other in terms of comparison, in terms of functionality, we would actually apply, this kind of, filter, and tell them that the comparable companies should also have sales which are very, very close to, the taxpayers situation. So the kind of filter that we apply is 10 times the turnover, or the next, or the kind of, maybe 10 times the turnover, or 7 times the turnover, or something like that. Or we can give them a bracket, 0 to 100 crore companies, so that will actually just exclude companies which have a turnover of more than 1,000 crores or 500 crores, etc. This is also the part of comparability factors that we were discussing. If you guys remember, we were discussing this comparability factor, which was called as business strategies. So that basically means that you wouldn't want to compare a startup company with a well-established company. How will you do that? Well, you can apply a filter, which basically is the turnover filter, and that will give you those kind of companies. The next kind of quantitative filter that we can apply is, let's say, export sales, foreign sales by total sales. So if your related party, if your taxpayer has a lot of export sales, you would also want to have, comparable companies with export sales. So this is another thing, that you can do. If you have a taxpayer which has spent considerable amount on research and development, you can apply this kind of filter also. Then if you have information on number of employees, and this information is something you can get from the software easily, so you can apply a number of employees kind of filter. Then what you can do is ratio of research and development to sales. So you can calculate a ratio for your taxpayer, and then use that particular ratio so as to see comparable companies which also have similar ratio. This basically means that your independent party has also not spent a lot on research and development, and they also don't have a lot of valuable intangible. So what you're trying to do using all these quantitative filters is you're trying to make comparable companies very, very close to your taxpayer in terms of functionalities out there. Then there is another type of filter that we use, which is called as consistently loss-making companies. If you have a comparable company which has made losses in 3 years out there, then you wouldn't want to compare it to your taxpayer, because your taxpayer is a profit-making entity. So you will actually exclude that kind of company also. However, if you have your taxpayer as a profit-making entity, and you have the comparable company that has actually made profit loss in just 1 year, otherwise it was profitable, but it was just in 1 year that it actually made a loss, then you wouldn't want to actually exclude them. This could be abnormal situation, this could be anything, and it's okay to actually compare it. But if it is a consistently loss-making comparable, then you would want to exclude it. So these are the quantitative filters that we apply, and these are the filters that we apply in, let's say, an Excel sheet. Practically, we use all those formulas. We create formulas in Excel sheet so as to apply these kind of filters, and they help us bring down the number of companies to, let's say, just as an example, let's say that now we have 50 companies. So from 207, we're left with 50 companies out there. So this is quantitative filtering. Any questions here? Too much to absorb? Any questions? Okay, any perspective? Okay, thank you. So this is basically quantitative filters, and this is just an example that I'm giving you. Let's say that, after quantitative filtering, the Excel sheet gives you the number of comparables as 50. Now, onto those particular 50 companies, we will apply something called as qualitative filters. Now, what are these qualitative filters? Well, let's say that this was, our taxpayer was an automobile company, and they were manufacturing brakes. Okay. Now, when we found out comparable companies, When we found out comparable companies using the software, we were able to do that for automobile sector, and now we have 50 companies with us. Now we find out that our taxpayer, basically in terms of break also, there is a very specific breaking part that it actually manufactures. Let's say it's called ABC breaking part. It's just like a very small part in the brakes itself that it actually manufactures. Now we would also want the comparable companies to manufacture that particular part within the brakes itself. So what we'll do is that for those 50 companies, we will open their annual report. We will go to their website, and we will just try to Google their information on a qualitative basis, and we will try to find out, do they also make braking parts? For sure, but then do they also make that specific part in that braking parts? Or these are, I understand 50 companies as automobile companies. Do all these 50 companies are also making braking parts? So what we're really trying to do using qualitative filters is get them very close in terms of product also. They're all in automobile sector, but then are the kind of manufacturing that they are doing very closely associated or not in terms of the product or not? This is what we're really trying to do. So when we open, this is a manual process that we do in terms of qualitative filters. Yes, for those 50 companies, for all those 50 companies, we'll have to open their balance, annual reports, director report, or Google it, or just go to their website, etc., and see whether we are accepting that particular company or rejecting that particular company on the basis of functions. Now these 50 companies could also belong to the automobile sector, but are they also a manufacturer, or are they a distributor? If they are a distributor, we would like to reject them. If they are a manufacturer, we would like to accept them. Why? Because our taxpayer is a manufacturer. So these are the kind of product filter, functional filters that we actually make at this kind of level. Practically, there could be also instances when I had just started up my career in transfer pricing. I remember, as a accept reject matrix, we did it for more than 500 companies. I remember that we actually looked at on Google and on annual reports and on their website to find out whether they were uh, closely functionally related to the taxpayer or not. So this is one exercise which is a little tedious, but this will actually help you get companies very close to the taxpayer. So this is a manual exercise, and this is also called as an accept reject matrix that we make from a transfer pricing perspective. So we accept or reject companies out there. So from 50 companies, let's say that now we have actually gotten to let's say 12 companies out there. For these 12 companies, now we'll actually undertake the benchmarking out there. We'll actually try to calculate the profit margin of these particular 12 companies. Now, but have you understood how we've achieved these 12 companies? And then I will go on to explain what we do next. Okay, great. Okay, thank you. So now for these, for these 12 companies, what we will do is, the next thing is the data to be used for analyzing comparability. Now, if you have actually noticed, we used 3 years data. If you see here, there was year 1, then there was year 2, and then there was year 3. So even for those particular 12 companies, if you see, we were able to find out, these particular 12 companies. And for these, 12 companies out there, we have net operating margin. We used their, financials, etc. And we were able to find out the net operating margin for year 1, year 2, and year 3. Now, the thing is, we need only 1 year information. So this is where this basically said that, initially it was actually only for the current year. But now what they've actually done is that you can use multiple year data for the purposes of calculating profitability. How do you do that? Well, CBDT came up with Rule 10b-4, and they came up with this notification 83 of 2015. And they basically said that where you're using the RPM, TNMM, or CPM. So resale price method, TNMM, or the cost plus method as the most appropriate method. Well, then you can use multiple year data. You can use 3 years of data and then come up with a weighted average out there. So this is going to be year one, year two, year three. And then for all those 12 companies, we'll create weighted average percentage, weighted average net margin, which is going to be for a weighted average of year one, year two, and year three. Why? That is because, if you actually look at current year data, it could be distorted by differences in market condition. You know, when I said that there could be a company which has maybe earned losses in 1 year, but otherwise it was, from a multiple other years, it was not making losses. So if you actually reject that company for the loss that it made in that particular year, this might just make you go away from a company which is very, very comparable, but it is just because it's made losses, you're actually rejecting that particular company. So this is the reason only current year data should not be used. You should use multiple year data because it's not influenced by abnormal factors or differences out there. So this is the reason multiple year data is actually better in terms of its usability. And even if we use multiple years, we actually create a weighted average of the net operating margins. And that is, what we actually use for the purposes of comparability. So for those 12 companies, we will use a weighted average out there. That will be the current year, and then you can go back, a few years out there, especially if current year data is not available. So this is the reason you can use multiple year data for the purposes of comparability. Now, the next thing is, what happens now that you have actually 12 companies out there? How do you compare your taxpayers' 1% to 12 operating percentages, out there? How do you do that kind of, exercise? Well, that is where we have the concept of arithmetic mean, and we also have the concept of interquartile range. If you can just allow me 1 minute, I will just share the screen to help you understand how we do this particular step. So just allow me a minute. Okay, can you see the screen now? Okay, so this is an example right here, which basically says that now that I have 16 companies, out here. Let's say from 12 companies, we have 16 companies out there. The name of the companies are mentioned here, company 1, 2, 3, 4, till 16 companies. And these percentages are the margins. These are 3-year weighted margin. So what we've done is for year 1, year 2, and year 3, we have actually computed 3-year margin. We have computed the weighted average margin of 3 years, and this is the result that we have actually gotten. Now my question is, how do I compare? Let's say my client's profit margin is, let's say 15%. Now how do I compare that to these, companies out there? Well, that is where the India has introduced the concept of interquartile range. There was a time before 2014, we used to have the concept of arithmetic mean. So what we used to do was to actually compute the arithmetic mean of these 16 companies. So, add all these margins divided by 16, you will get a percentage out there. Let's say that the percentage is, maybe 8%. Just as an example, let's say that the arithmetic mean of these, companies is 8%. Do you feel that arithmetic mean was the right, statistical tool to compare this kind of situation? Do you think arithmetic mean would have been the right thing? Okay, not right. Why do you say that? Okay, not comparable. Well, if you look at arithmetic mean, I somehow feel that it was not the right thing, because if you've gotten an arithmetic mean of 8%, 8% is not really representing a company which has earned 0.83% of profit. It's not really, representing company which has earned 1.80% of profit. It's not really representing them, very, very correctly or very, very closely. It's not even representing a company which has earned 13.90% of profits. So I somehow feel that using arithmetic mean was not the right step, because it's not really closer to economic realities. It's not really correctly representing all the companies that are available in this particular set of companies. So this is the reason India, because they wanted to move in with global best practices, because around the world they did not use arithmetic mean. It was India that was actually using arithmetic mean. So as to align itself with global best practices, India introduced the concept of interquartile range. Now, interquartile range was something that was being used around the world also. So what they actually now do is use interquartile range of 35th to 65th percentile of the data set. So what they do now is to create 35th percentile, and then they create 65th percentile, and they sort of create a range out here. They calculate, you can use Excel, or it's provided in Indian rules. Indian transfer pricing rules also provide on how to calculate the quartile range. So what you can do is you can use those particular rules out there to calculate the quartile range. So what they have actually done is to provide a range out there, 35th percentile to 65th percentile. And what you do is, after creating that particular range, if your taxpayer's margin falls within the range, then this is at arm's length. Okay, so what they have actually done is, and it's provided in the institute's example. In the manual, we'll use this particular example, and I will tell you how do you compute the range. But what I'm really trying to say is that first you compute the 35th percentile, then you compute the 65th percentile. If your margin falls within the range, then you are at arm's length. So let's say, using all these particular companies, let's say that the 35th to 65th percentile comes to 3% to 19%. I know it will not, this is not the right thing, but let's say that the range that we have actually gotten is 3% to 9%, 19%. Our taxpayers' profit margin is 15%. Do you think this is at arm's length? Well, yes, this is at arm's length. There is no, confusion about it. That is because the taxpayers' margin is within the range itself. So this is going to be at arm's length. Now, let's say that the margin, that the range that has been constructed using, all these things, the 35th to 65th percentile, that is 4% to 12%. This is the range. What is the taxpayer's margin? The taxpayer's margin is 15%. Do you think it's at arm's length? No? Okay, let's think again. Well, yes, it is going to be at arm's length. Well, why? Because what is the range? What is the maximum that the independent parties are earning? Well, this is the maximum that they're earning is 12%. Well, that is because that is the, that basically means that they are paying tax on 12% profits. What are we earning? We are earning as taxpayers, let's say from the taxpayers' perspective, they are earning 15% margin. So the kind of tax that they're paying is obviously on 15%. So are they at arm's length? Yes, they are at arm's length. They're not trying to conceal profits out there. They are obviously earning more than what independent parties are earning. So this is also going to be at arm's length. Well, what if the client is earning or the taxpayer is earning 2% and the range is again 4% to 12%. So range is 4% to 12%. Taxpayer is earning 2%. Do you think this is at arm's length? No, this is not at arm's length. Yes, you can say that you need a margin greater than the 35th percentile to qualify as ALB. But the fact that, the reason that we need a range concept, we need 35th to 65th percentile is because there are adjustments that are actually made using that particular percentile out there. So this is the reason, later on when adjustment level at that particular level, we need the 35th to 65th percentile. So yes, that is the concept of range that India has actually introduced. Now going back to what the law basically says. The law basically says that this is the Finance Act 2014 that introduced the concept of arm's length range. It's more like interquartile range, and the interquartile range was always there in OECD. Now it's available, this kind of concept of the interquartile range or the arm's length range. It is available for all the methods except PSM and the other method, except the profit split method and the other method. So this kind of situation is available for CUP. It's available for TNMM, RPM, CPM, etc. And the kind of range that we have in India is 35th to 65th percentile. You will also see that the kind of range that other countries follow is 25th to 75th percentile. This is something which is provided in the OECD percentile, just correcting the spelling out here. But yes, this is what is provided in the OECD. OECD says that you can have 25th to 75th percentile. There are so many countries around the world that have 25th to 75th percentile, but in India, we follow 35th to 65th percentile. Now, the question is, what happens to the arithmetic mean? Do you think we have done away with the arithmetic mean? Well, not really. The arithmetic mean is still there in India, but they basically say that only if you have comparable companies less than 6 can you use arithmetic mean. So if we have the number of comparables 6 or more, you have to use the range concept. So 6, 7, 8, whatever the number of comparables that you have to use the range concept. But if you have comparables till 5, you can use the concept of arithmetic mean. So for 2 comparables, 3, 4, and 5 comparables, you can still use the arithmetic mean. But if you have comparables 6 or more than 6, then you have to use the interquartile range. So yeah, that is the concept of range and arithmetic mean. Just take a minute and just read through this. Does it make sense? I will tell you how to apply the range concept in just a while. So just take a minute and read through this. Okay, any questions now? Does this make sense? This is exactly what we've discussed. Any questions? Any questions on the entire, search process? How do you find out comparable companies? How do you compare the, margins, etc.? Anything? Okay. Last point is this one on this particular slide. Yeah, I will explain how to apply in just a while. Just give me some time. I have these two examples. I will use those two examples to explain how to apply. Okay, so now the thing is, how do I apply the range concept? The first thing is that if you have, like a data set, let's use this particular data set out there. So the first thing that you actually do is arrange the margins in an ascending order. So what we'll do is, I think I have the slide available for that. Sorry, just allow me a minute. I'll display that slide as well. Okay, so this is, how you actually do that. Is this visible, guys? Sorry. Okay, now is it visible? Yes. Okay. So what you do is in terms of, applying the range concept. Okay. In terms of applying, the range concept, what we do is, uh, we first arrange all the companies in an ascending order. Don't go by, the percentiles that are actually provided here because this is tile. But what we do is we actually arrange all them in an ascending order. So, the company that has earned 0.60% margin comes first, and then company 12 comes in, which has earned 13.90%, margin. So this is going to be step one. Let's say that the data set that we basically have has, again, but are slides visible? Okay. Okay. So, in terms of, now just understanding how do you calculate the range, the first thing is that now the data set comprises of 7, data points. The reason that I'm doing this particular example is this is provided in the manual as well. So now the data set comprises of 7 data points. The first step is that for all those, companies, let's say that this is still 7 right here. For all these kind of companies, you have to arrange them in an ascending order. After actually doing that, we actually find out that, this particular thing is not a whole number. We're talking about 7, right here. So how do you compute the 35th percentile? Well, what you do is you multiply 7 by 35%. This will give you the result, which is 2.45. 2.45, you have to round it off to the next value. Let's say that this is going to be the third value. So what you'll do is look at what is the company which is appearing on the third value. On the third value, we have company 8, and what is the margin? It is 1.80%. So this is going to be 1.80 is going to be the 35th percentile. So just explaining that again, what do you do? The 35th percentile, that basically means that multiply 35 percentage by the number of companies out there. You get 2.45 as an example, as the result. That basically means that the value will be the third value. So in terms of how you've arranged the companies in an ascending order, whatever company is appearing on the third number, whatever is the percentage that they have earned, whatever is the margin they have earned, that will be considered as the the 35th percentile. So in this particular situation, it's going to be 1.80%, which will be the 35th percentile. Now for 65th percentile, you do the same exercise, multiply 65% by 7. This will give you 4.55. That basically means the company which is appearing, the margin which is appearing on the fifth number, that will be the margin. And what will be the median? The median will be 50%. So 7 into 50%, this will give you 3.50. That basically means the fourth value will be selected. Just give me some time, I will explain why the median is actually required. But in this particular situation, let's say what is the fifth value? Just as an example, the fifth value is 3.83. So this is the reason 1.80 is the 35th percentile, 3.83% is the 65th percentile. And what is the range? The range is now 1.80 to 3.83. This is the range that you have constructed, the 35th to the 65th percentile. Why is the median important? I'll just let you know. But any confusions here? There are also situations where people, use Excel. So, they'll use Excel, they'll put in a formula there equal to percentile of, this the 25th percentile or the 35th percentile, whatever you need to calculate. But this is the manual exercise on how to calculate percentile for the purposes of this situation, the range. Shall I explain this again? Okay. Now, the next thing is what happens in the situation where this is going to be a whole number. Let's say that there are 20 data points. When I say 20 data points, let's say that there are 20 comparable, companies out there. The first thing again is to arrange them in an ascending order. Now, what will be the first percentile, the 35th percentile? The number that you actually get is 20 into 35%, which will actually give you 7. Now, this basically means that it's not going to be the seventh percentage. It's going to be the arithmetic mean of what is appearing on the 7th point and the 8th point. So that basically means if you've gotten 7 as the 35th percentile, it basically means it's going to be an arithmetic mean of 4.34 plus 5.12 divided by 2. This is how it's actually done. So if you get like a whole number, a 7, what you do is use 7th margin and use the 8th margin and compute the arithmetic mean. That will be the 35th percentile out there. Similarly, what is the 65th percentile on 20 data sets? It's going to be the result is 13. That basically means that the value will be the 13th number and the 14th value. Put them both together and calculate the arithmetic mean. That will be the 65th percentile. So 65th percentile will be 13th value, which is 8.70, plus 14th value, which is 8.74. Sorry, divided by 2, that will be the 65th percentile. And what is the median? It's going to be 10. So that basically means that it's going to be the 10th and the 11th value ka mean, the arithmetic mean, that will be the 50th percentile in case of whole numbers. So this is how you actually calculate, the margin. Any questions till now? I think you can take a minute to read through this and then I will explain. Okay, if it's clear. Okay, now the thing is, what is the relevance of median that we've been discussing all this while? Well, the relevance of median is that what if my margin is 4% to, let's say, 8%. This is, the 35th to the 65th percentile. My 65th, my 35th to 65th percentile is 4% to 8%. Now, the taxpayer is at a margin of, let's say, 2%. In terms of this, the 50th percentile, just as an example, the 50th percentile is, let's say, 5.5%. So now the point is that obviously, is it at arm's length or not? Well, it is not at arm's length. Why? Because the taxpayer is below the range. The taxpayer does not fall within the range. So what will happen? There will be a transfer pricing adjustment out there. Now the point is, how much will be the transfer pricing adjustment? From what point will the tax authorities do a transfer pricing adjustment? So this is where they say that the transfer pricing adjustment will happen from the median itself. So what they'll do is the taxpayer has earned 2%. How much the taxpayer should have earned? They should have earned the median, which is 5.5%. So how much will be the transfer pricing adjustment now? The adjustment will be, okay, that's for you to answer. The adjustment will be, exactly, it's going to be 3.5%. So what I'm really trying to say is that, yes, that's correct, 5.5 minus 2. So what I'm really trying to say is that the adjustment actually happens from the range, sorry, the median. So this is where the last statement, if you see, just take a minute and read through the how to apply portion. Now, does it make sense? Okay, clear now? Okay, thank you so much. I think with this we finished this particular slide, but because we have some time left, I'd just like to give you a brief idea on what documentation, from a transfer pricing perspective, really looks like. What we can do is we can take again a 10-minute break, take a breather, and then we'll come back and discuss, documentation from a transfer pricing perspective. Everyone, and welcome back. Can you guys hear me and can you see the new slide deck? Okay, thank you. I'm actually getting a lot of requests for a quick revision to what we've discussed.
Recording in progress.
Okay, so we will continue with documentation, and these are a few slides that I wanted to talk about. A new concept in transfer pricing, which is called as documentation. Now, when it comes to documentation, I think this particular slide very correctly summarizes why documentation is important. Transfer pricing documentation is important because it will protect the multinational enterprises from transfer pricing penalties. When I say that it will actually protect it, that is because when you look at transfer pricing perspective, it is obviously a very elaborate process, an elaborate process in the sense that it will require a lot of judgment, a lot of findings that will be put in the transfer pricing documentation. But then there is a dual purpose that it actually performs. One, obviously, you would be adhering to the legal obligation of maintaining the mandatory information. So it's provided in law, and you are abiding by the law when you're actually preparing this particular transfer pricing documentation. And the second thing is that whatever transfer pricing policy that you have undertaken as a taxpayer, and I'm talking about from a taxpayer's perspective, whatever transfer pricing method you have chosen, howsoever you have tried to benchmark your transaction, whatever database you've chosen, whatever set of comparable companies you have actually chosen, it will actually help you substantiate it before the income tax department. And this is at the stage of scrutiny. So one, it's going to be it is obviously a legal obligation, and the second thing is that it will actually help you justify the transfer pricing position. When I say you today, I am referring to from the transfer pricing from the taxpayer's perspective. So just keep that in mind. Now, when it comes to transfer pricing documentation in India, there it is twofold. When I say twofold, there is something called as Form 3CEB, and then there is something called as transfer pricing study report. Just putting it out here, there is something called as accountant's report that is to be maintained. Accountant's report is also Form 3CEB. And then there is something called as transfer pricing study. Now, this is what the accountant's report really looks like. This is Form 3CEB. This is coming from Section 92E of the Income Tax Act. Now, what does it do? Well, this is going to be a very concise, document. And this particular document is to be obtained by every person who is entering into an international transaction. There is mandatory e-filing by 31st of October. And this is a form that will actually provide an opinion that the international transaction are at arm's length. Now, when I say that the international transactions are at arm's length, this is actually a certification which is given by a practicing chartered accountant. And this is mandatory filing, which is to be done for this. Now, when it comes to the accountant's report or Form 3CEB, there are three parts to it. There is Part A. Part A will say just general information about the taxpayer. It will say the name of the taxpayer, what are which financial year, etc. What is the aggregate value of international transaction that they have actually undertaken. So what you'll do is whatever international transactions you've undertaken with whosoever associated entity, you will aggregate the amount and put it there. Then it will ask for the details of the associated enterprises. It will say that what is the name of the associated enterprise, what is the country, what does the associated enterprise do, and under which clause is the associated enterprise associated. So if you guys remember, we were discussing these 13 instances. Those are all provided in the form, and one is to be selected. Which clause do you think, under which clause is the AE associated to the taxpayer? That is what you have to provide there. So that is part A of Form 3CEB. Then there is part B of Form 3CEB, and part B will talk about all the international transactions that have been undertaken. There are, category of transactions out there, sale of goods, raw materials, tangible property, intangible property. There is another clause in part B which says service transaction, or deemed international transaction, guarantee transaction, borrowing transaction, capital transactions, etc. So what you have to do is, which clause do you fall under? Is it a service transaction that you've undertaken? If yes, go to that particular clause and then fill in details. What are the details? Which AE is the one with which you have undertaken that transaction? What is the description of that transaction? Is it sale of goods? Is it provision of services? It's in the service clause, so it's going to be service. But which kind of service? Provision of IT service, provision of BPO, KPO service, etc. What is it? What is the amount of the transaction? What is the amount as per books of accounts? What is the amount as per ELP? And which method you have undertaken to benchmark that particular transaction. So what is the most appropriate method you have taken? So what you do is use one method out there, and that is all the information that is provided in Form 3CEB. Similarly, there are other clauses also there where you can provide the information. If apart from service transaction, there is also a tangible property transaction. Well, what you do is you go to that particular clause, say which AE was the one with which tangible property transaction has happened, what is the nature of the transaction, what is the amount as per books, what is the amount as per ELP, and then what is the method that has been undertaken to benchmark that kind of transaction. So that is part B. And similarly, there is part C. Part C is for specified domestic transactions. Specified domestic transaction is something that we will discuss. It's provided here. We will discuss in the next lecture. So that is what is provided in part C. So that is all that is provided in Form 3CEB. Form 3CEB is a very, very concise document in the sense that it just provides information on the taxpayer, basic information on the associated enterprises and the transactions that have been undertaken with the associated enterprise, and what method you have undertaken. It just looks for the name of the method that you have chosen to benchmark that transaction. That is all the information that actually goes in Form 3CEB. Now, apart from Form 3CEB, there is another document that you have to prepare, which is called as TP study. TP study is provided in, it's coming from Section 92D of the Income Tax Act. And this is where you will actually provide a lot of information. This is a document that we have to, as taxpayers, prepare. And this particular document will just provide a lot of detailed information on the entire transfer pricing policy and the entire transfer pricing analysis, that is undertaken. So this will actually start with enterprise related information. So first part of TP study will be, and there is no format of TP study. We have to create it on our own. So the TP study will start with what is the ownership structure like, what does the taxpayer do? What is the ownership structure? What are the associated enterprises? What is the profile of the group? You have to explain that in a lot of detailed, manner. Where does the associated enterprise where are they registered? What are the details? What clause do you think are the entities associated under? So Section 92A, which clause are they associated? Then you have to go into transaction-wise details. So under transaction-wise details, you tell them that the first transaction was a service transaction. And a service transaction, you have to explain that a bit. Then you have to say, what does the FAR analysis really look like? What is the tested party? how have you selected that as the tested party? If you feel that this is the least complex, how do you feel that this is the least complex? You have to provide a justification out there. Then you have to say which method are you selecting for the purposes of benchmarking that service transaction. If you say that we're using TNMM method, you have to give proper explanation to say why are you using the TNMM method. Then you have to get into the benchmarking exercise. So now you have to calculate the operating margin of your taxpayer. After that, you have to use the database. So you have to provide information on what database have you used, what were the filters that you have to use, that you have used, what are when you first entered the database, how many companies were there, then when you used these particular filters, how many companies were remaining, then finally how many companies were there. Then you have to give all the explanation on how did you calculate the operating margin of those comparable companies. And finally, from, let's say, 204 companies, when you came to 12 companies, how did you come to that particular filtering? Then for those 12 companies, you have to calculate the operating margins, and everything, all the calculations relating to interquartile range, etc., everything goes into the TP study. If there are any adjustments that you are actually making in the TP study, in the transfer pricing analysis, that also goes into the TP study out there. So what I'm really trying to say is that the TP study is a very, very detailed document which sort of complements the Form 3 CEB. Now, one important thing to note is that when it comes to Form 3CEB, this is a mandatory form that has to be filed. So even if there is, like a ₹1 transaction, international transaction, with the associated enterprise, even then you will have to file Form 3CEB. But when it comes to TP study, the requirement is to maintain TP study. So going forward, if there is, any requirement to present TP study before the tax authorities, you can easily do that. So the requirement, we don't file the TP study, we have to maintain TP study is what the law basically says. And the threshold limit for TP study is when the aggregate book value of international transaction exceeds 1 crore rupees. So it's only after 1 crore rupees that we actually maintain the TP study. Otherwise, till then, you can just have Form 3CEB filed with the income tax department. So that is what, the documentation structure that we have to maintain from an Indian transfer pricing perspective. In the next lecture, when we go forward, I will explain, the documentation structure which has been brought in by the OECD, which is called as the 3-tier documentation approach from the OECD, and India has introduced and India has incorporated this approach in Section 286 of the Income Tax Department, Section 286 of the Income Tax Act. So yes, that is what we will discuss. A question right here: how can file 3CEB without TP study? Well, if you don't have, well, everything is provided. If you've undertaken transactions, you have to file 3CEB without TP study. I did not understand that. Well, the transactions have been undertaken, and you can maintain the TP study. There is no harm, but the requirement will not be there at the scrutiny stage to present it. So you can maintain TP study even then. Okay, can you explain your question a bit further? I think I did not understand it. Yes, that's correct. So 3CEB is, something which is mandatory e-filing. So even if you have transactions, still you have to file 3CEB. 3CEB is, just provided there. It's like filing TP3CEB, but you have to maintain TP study. So you don't have something which is extensively available, but at least you know that, how are you justifying that kind of, transaction? It's still there. But however, the point is that if you're using a TNMM method, it's always beneficial to, just maintain a TP study, even if the transactions are less than 1 crore rupees. So you can do that. You can have the calculations and, the benchmarking exercise, provided there. But it's the requirement of law, which basically says the maintenance. Companies, they have it available in any case. We have a TP study most of the times. For international transactions, 1 crore is, quite less of a threshold. We don't generally see this kind of, threshold. It's only a lot. Anyway, coming back, so this is, what is provided in the local documentation. In the next lecture, I'd like to start with, the international documentation. I think I'd like to start with specified domestic transactions and then go forward with, the documentation structure. In the next lecture, this is what I plan to, cover. Specified domestic transactions, the documentation structure, and we'll start with what are safe harbor rules, what is the dispute resolution mechanism look like in in India. What I'd also like to cover for the next lecture are some very, very specific issues and a little technical also, which are called as secondary adjustments, and these are called as interest limitation rules, section 94B. And after that, we'll discuss a very small portion relating to penalty with respect to transfer pricing. So I think for today, this is all that I have. If you have questions, feel free to post them. I will be posting the slides for sure. So if that was the question on your mind, I'll be uploading the slides very, very soon. And I think that's it from my end. Thank you so much for today, and I will see you guys in the next lecture. Thank you. Thank you so much. Yes, sir. Thank you. Good night.